just a quick background about me. I am not too far from you guys. I'm in San Francisco in Northern California. Um, I've been a financial advisor on and off, first for the big guys in the Silicon Valley, and then finally have my own practice in the last 4 years. We're a team of 5. When Ivy reached out to me, I was super excited because this year, specifically during the pandemic, our goal is to really educate people. That is, just talk about our human nature, which is to spend, to, not think about things that bothering us. And my job is to really push. And so I guess the reason I'm sharing kind of our philosophy and why we're doing this is I want you to ask questions. Money is a sensitive topic. It is also a very emotional topic. So if you don't feel comfortable sharing it with the group, you're welcome to private message or reach out outside. But this is just, we're going to talk about general concepts. In the end of this workshop, I'm going to send Ivy a little Excel spreadsheet. Each of you will have a little homework to do. That is your budgeting. And it's a fun exercise in being honest with yourself. How much are you really spending? Do you really have an understanding what's going on with your finances? But really the key for today is just please keep asking questions. I'm going to share a very basic, I call it financial planning 101, a little presentation. At any time, I will check the chat box. Feel free to ask a question. I'll unmute you, or Ivy will unmute you, and we'll talk about it. I think that's it. Unless you do have a question and you want to start with a question, we can. But otherwise, I'm going to start with a little presentation. And Ivy, if you don't mind, I will ask you to be my person. Can you see the slide that I'm actually showing right now that says financial basics?
Yes, it's visual.
It's visual. Fantastic. So I don't know how many of you actually do spend some time thinking about your finances or the future, but really my job quite often is to prompt our clients to think about beyond what's in front of them. And I know it's hard, especially when we're going through a pandemic, we don't have jobs, or we're worried about losing a job. But it's really all the financial basics really start with you understanding what is it that you want to get out of life, right? So that's the big question. Some people are really good about it, kind of answering this question. They have a clear plan. I want my Tesla, or whatever that is, right? Or I want my house, kids' education planning, retirement planning, and some people really don't know. But I would encourage each of you, let's keep it like not too far in the future. Ask yourself that question, what do you want to see happen in your life, not just financially, but also it could be personally, it could be professionally. Like, I know, again, professionally, we have no control over what will happen in the future based on your industry, but just think about it till the end of 2020. And then if you have the time, you want to think beyond, I encourage each of you to, homework will be write down a little list of here's where I want to be professionally in 3 years, financially in 3 years, personally in 3 years, and then you can take it beyond that as well. So it all starts with this question. Financial fitness worksheet, this is something personally, I will ask each of you, or you can tell me, I don't believe in homework. I don't want to put more homework with you. Those are some questions that we ask our clients, the 8 questions to understand where they're at. And the questions are, how well are you acquainted basically with your finances? Are you friends with your debt? Do you know where you're headed for the future? What does retirement look like for you? If you have kids, family, like what is it that you want to provide for them? So we generally ask those questions. I'll check in with Ivy if you guys want. I'm more than happy to send it so each of you can do a little homework. Just it gives you a sense of how well you are prepared for the future, and then how little you know about finance and how much you want to know. So those are just questions that we just always start with. But before we go there, this is one of my favorite things I wanted to talk about as a starting point. You see the 5 key actions. We generally think of money as just zeros in a bank account. As a financial planner, it's beyond the zeros, right? When I'm talking to you guys, is I really want to understand your psychology around the money, where you came from, right? And then also there's different things that we can do with money. Most people, at least I'm gonna just generalize it, in the Bay Area, they spend it. They spend a lot of time just spending it. Some will grow, especially the ones who have 401ks or that are investment savvy or have had some education. The protection is really important. I think it was Jacqueline, we talked a little bit about health insurance, just insurance planning to protect your wealth and your well-being. We give, generally, this is for us is the end, kind of, it's a cycle, right? When we see our clients are really well prepared, they're doing okay. And generally it's our human nature to also give back to the community. How you do it, it's up to you. Could be an organization you're passionate about, and of course saving. Again, I would love to hear a little bit of maybe do a little toll and see how many of you actually do all those 5 things with your dollars, right? Most of us, we just think about spending or perhaps growing, giving, but generally the concrete financial plan will involve all of those 5 aspects in terms of your dollars. The only other thing that I think about, it's not in this slide, is again, it's not just about the zeros. I always have to think about the taxation, which is a big problem that we have, especially in California. We live in an expensive state, as well as location of your dollars. Is it safe, or is it an aggressive environment? Is it accessible, or perhaps it's tied to your home? So there's a lot of things that we think about when it comes to dollars. Excuse me, I know I'm talking really fast. Let me know. So, and then what I would like to do is just go through each of those categories, and I will pause just to see if you have any comments. And saving, it's to me, most people that I talk to, 99.9% of the people I talk to, they have the greatest intentions. They all want to save, but we just simply don't, right? It's just when we see dollars, we spend it. But as I mentioned earlier, as I was chatting with Jacqueline, is if we don't save and prepare for tomorrow, you know, we just really don't have a financially secure future. Yeah, that's pretty much it. And if you don't mind me asking, maybe can we do like a hands? Ivy, I just want to make this an interactive, like how many of you, you know, consistently save every single month? I'm not sure. Here we go. Here's Zelda. Thank you. I just see. Yeah. Here we go. There's Wendy. Fantastic. And as I was, 1 second, I'm gonna actually go back real quick here. That's phenomenal. So here's, thank you for your for playing the game with me with the hands. It's a little challenging not being together. So math is of course a science, and we simply know that if we sooner we start saving, better off we're going to be in the future. The reason I really love math is because we know that, you know, 50% of our wealth in the future will come from that very first 10 years of saving and investing. And let's also pause for a moment and talk about how saving is a very different concept than investing. We can save in a bank account, which I encourage as a planner to have, you know, money in a bank account at all times. That's 6 months of your expenses. If you don't already have it, I encourage all of you make that as a priority, especially right now what we're going through. That's the foundation of all financial plans, having an emergency fund, 6 months of your expenses in your bank account. However, but if we keep a large capital in a bank account, unfortunately, banks are paying less than 1% currently. The inflation rate in California is 3.2. If you don't know what inflation is, that's costs of goods and services. They grows by 3.2% each year. Plus, the money in a bank account is taxable. So if we keep a lot of money in a bank account, we really are not going to see a lot of growth. So how the wealth is built, we gotta save and invest. So we're earning more than 3% to actually grow our dollars. So coming back to math, we just know that anyone who starts saving about 20% and invests, and that just guarantees, and you do it consistently month after month after month. And I always tell my clients, see the bigger picture. The bigger picture is that you're only saving 12 times a year. It's really, it's just building a habit. Just like exercising, we gotta just build that habit. So 20% is the magic number. Think about it. And here, I guess I jumped ahead of time. Having an emergency fund is incredibly important. And based on my conversation with Ivy, I understand that a lot of you guys are out of work, and a lot of people here in the Bay Area as well lost their jobs, right? They thought they had comfortable jobs, let's say Airbnb or Lyft, and they don't. They were let go. So emergency fund is there to protect you against going into debt, to prepare you for an unexpected event and expenses. Again, I'm going to just pause. If you have a question, please chat, and I will try to get to you guys. Let's do this. Emergency fund is just giving you a little, some statistics. You know, most Americans don't even have $400 in their account, just, you know, to cover expenses. And actually, the number is actually grim. I'm going to pause for a moment because there's a few questions coming up. Zelda is asking, is the emergency fund the same as savings or a separate account? Emergency fund is the savings. Ideally, you will have a checking account. That's where I call that floating account, because the money comes in, goes out, because we've got to pay rent or mortgage, bills. Savings account is that your emergency fund, about 6%. I also think of emergency fund as an opportunity fund too. So it's not a, do not ever touch it. It's there if your car needs new tires. I used to say when you find those cheap tickets to Europe, but now we can't go anywhere. But it's really there, so you're never worried about money. Again, Barbara has a great question, so I CC. To me, really, emergency fund is a fund that is in the bank. Why? Because banks have, they're FDIC insured, right? They're going to protect you up to $250,000. Plus, it's accessible, it's liquid. So regardless if it's checking or a savings, it's up to you. Unfortunately, neither accounts are paying very much in interest. As long as you have access to liquidity, psychologically, some of my clients separate them, savings, checkings, because if they see it in a checkings, they just spend it. When it's in the savings, it's kind of psychologically, they say no. That portion of it's going to be based on who you are as a person, right? If you're, let's say your emergency fund, it's supposed to be 30,000, you have 30,000 you're checking and you're not touching it, great, keep it at that. But if you see, but it's again, it's our human nature. We see money in the account, we just tend to spend it. It's really up to you, as long as it's in a bank account. I hope this is answering your questions. Yeah, I love it. Just keep chatting those questions. It's going to be great. Let me just check in. Wonderful. My pleasure, Barbara and CC. And yeah, so again, it's just a little bit of statistics about emergency fund. The recent statistic is that 56% of Americans do not even have $1,000 in their bank account for emergencies. And those are individuals who have mortgages and children. From the planning perspective, that is incredibly risky. And it puts them in a position to go into more debt if they, you know, again, I'm using the car as just an example, because if car needs new tires. So here is just, again, just a visual portion of it. 6 months of your expenses. Why 6 months? This is really based on data. We find that if we have an injury, we got into an accident, or we were let go from our job. Generally, most people are able to resolve those things within the 6 months. And having 6 months of your expenses in your bank account would allow you to pay the bills while, let's say, you're looking for a new job. Or I use my husband as an example. We live in San Francisco, so we can't drive anywhere, right? No parking. He was biking from work, and an AT&T truck hit him. He's fine. He was just badly bruised, but he didn't work. So for 6 months, and that's there to protect us while we have a little one at home. And so those are reasons why we need it. Spending. Here's a fun fact about spending. Most people think that you shouldn't spend. I have a different philosophy. I think it makes us feel good to spend money. It makes us feel good to hang out with friends. And go have a glass of wine, it feels good. And we come again from different cultures. I'm originally from Armenia. I think I saw someone Armenian as well with the last name. It's our culture is to get together all the time and have fun. And it's generally, I don't frown upon it, rather than we build a balanced budget where a certain portion of your income goes into saving, a certain portion of your income goes into spending. So understanding how much you need to spend each month without compromising your future is one of the most important things that you can do. And generally that's about 20% as well. If you're saving 20%, you can also save 20%. I'm sorry, if you're saving 20%, you can also spend 20%, and the general guideline is that the remaining 60% of your income should go to your essential expenses. That's rent, food, transportation, children, insurance planning, things that we have to pay every single month. So let me know if you have any questions about spending. This is the and I don't know how much you guys want, how much history you want, but I love to read history, just statistics. And just to digress for a moment, in the 50s, there was a study done on 100 individuals right after college. Granted, unfortunately, it was 50, so they only talked to men, not women. Quite unfortunate, but they talk to all 100 individuals, ask them what their dreams are for the future. And of course, every single one of them talked about successful careers, successful taking care of their family and kids and wealth. And then they followed up with them 40 years later. And statistics were really grim. I think a few of them had passed. Only one was wealthy. 4 or 5 of them were comfortable, like they were going to be okay and maybe even leave a legacy for their loved ones. Everyone else was broke. And basically the study revealed that it wasn't because they didn't earn enough money. It just, the study revealed that they just spent it. They just basically, it was a lifestyle. So if they wanted to golf, they did. If they wanted to take that very fancy vacation, they did. And they didn't save. Yeah, I want to see if you guys have any questions. Yeah. Good. All right. So how many of you track all your expenses? I know it cannot be fun to track all your expenses. Generally what thank you, Barbara, I see you track. I think it's actually incredibly important, not necessarily to be militant about it, but understanding your expenses. It's really, really important, and tracking them. So and basically, there's certain expenses we all know by heart, right? That is ingrained in our brains. That's mortgage or rent or car payments or car insurance. We have no choice. We got to pay those, and we know those numbers by heart. But understanding, your monthly expenses is really important. And Mikhail actually had a really great thing about with all the subscriptions, it's actually a bit tricky to track expenses. You're right, it is the subscription environment that we live in. It's really important to actually understand it. What are you subscribed to, right? Personal story, I just recently discovered that I've been paying Fabletics, which is actually owned by Kate Hudson. It's like a workout stuff, for months. And I've been paying them $50 a month, and I'm not buying anything or getting. So understanding what are you subscribing to every single month? Is it your, your Amazon, your, Spotify? I'm trying to see, maybe it's Wall Street Journal for me. But I know it's, no, you probably don't want to deal with it, but you must, right? Guess what I did? I just canceled that subscription, $50 a month. So I encourage all of you, as we come done with our workshop and I send you the budgeting sheet, just spend some time and just really do it. You might realize that you're spending a lot of money on things that you don't necessarily need. Yeah. I want to again pause for a moment. I want to make sure if you have any questions, please type it. I enjoy seeing your questions. Yeah. The rule of thumb is if you're not using that particular subscription for about 3 months, if it's whatever service it is, if you're not using it, you probably don't need it. Just tracking your expenses, to me, it sounds so simple, but sometimes it's really hard. Money coming in and money going out. And yeah, to me, this is an exercise that each of you, I want each of you to do it. Personally, I spent quite a bit of time to perfecting it. It took about 6 probably months, but if you ask me, I can tell you exactly how much money I spend every single month on dining out, or at least my budget. It might be on the lower end, but I know what my budget is and I don't exceed that budget. So Zelda asked what tracking service we recommend. Mint is confusing. I'm 100% in agreement with you, Zelda. It's not necessarily confusing, but what we find our human brains are, when we sign up for those subscriptions, we use it 1 month or 2 months, and then at some point, even though Mint will send you emails saying track your stuff, we just simply don't do it. So what I like to do is just use that simple Excel spreadsheet where, and actually, when I finish with those slides, which we won't take too long, I'll actually share that with you, and we'll email it to Ivy so she can share it specifically with the entire group. So what I do is just, I like to say, okay, how much, what's my budget and how much can I spend, let's say, on dining out and supporting local businesses. So for me, that's $100 per week. Right? And it's like, okay, $100 per week, I can do whatever I want. I can go get that coffee, order from Indian food, or doesn't matter, but that's it. If I spend that $100 per week on that discretionary, or let's say if I spend it by Thursday, that's it. I'm not doing anything Friday, Saturday, Sunday. I'm doing something that brings me joy, like going to the beach or going hiking, that doesn't really require funds. But also, and there's certain bills that the tracking will be really easy because those are constant. Let's see, and I'm reading your comments, Zelda. Yeah, actually, Sarah mentioned it, and I agree that a YNAB app is actually really good. That's the one I generally recommend. It's just, maybe it's me, but I'm finding what happens sometimes, my clients just start ignoring those apps. And but I agree with Sarah. It's very intuitive, the YNAB. So check this out. Good. The next slide is just basically what I just talked to you guys about. Those are general concepts. Here's the good news and a bad news scenario here. In California, we find that unfortunately it requires more than 60% of our income to pay for our essential expenses. That's housing, food, loan, debt that you have, transportation, insurance planning. in the Bay Area, because San Francisco, unfortunately, is a little bit more expensive than Southern California, most individuals' income, about 80+% goes here. And then we have to, you know, make sure that we're balancing out the saving, investing, and spending money, because it's unrealistic for me to expect anyone to never spend money, right? It's like extreme diets. It never works. And so that's why we need to find a balance. First step for all of you, I'll encourage you, understand your essential expenses first. You know, do you know if, let's say, you have student loan debt, are you paying, are you not paying right now because of the COVID? Do you know exactly how much money you spend on food? So understanding this essential expenses will determine how much you should save and then how much you should actually spend. And this is a portion that if you ever need help, let me know. I'm happy to work with you individually and help you through it. But it's a simple exercise that each of you can do it on your own. Let's see. Any other questions so far? Anyone? Let me check. No, we're good. Okay, 1 second. I think I'm going backwards instead of forward. Growing your money. I find that most people I talk to are pretty savvy in terms of growing their money, in terms of, you know, investments. I'm not sure how you guys feel about it. Feel free to grade if you want to chat, kind of a type in a chat. Let's say A, you know exactly how investments work, mutual funds, the stock market. You know, F, you don't know anything, and then everything else in between, right? B, you understand a little. So if you want to type in, kind of grade yourself on your knowledge of investments, that would be great. Not too perfect. Cece mentioned she has a Roth IRA but doesn't know how it works. This is the part that I can, you know, Cece, let me just pause and say you're not alone. Congrats, number one, that you have Roth IRA. That's phenomenal, tax-free growth. But most people don't actually understand where the money is, mutual fund, how that works, the fees that they're being charged, and where is your money actually going and invested. Barbara, thank you for your comment. Here's again, certainly, I certainly don't want to make this a political discussion. I certainly don't want to do it, but we live in an environment where we do have a president who is constantly trying to bring in and connect stock market and economy as if it's the same. It's not, right? The stock market is the environment that world's largest companies actually live and exist, and combined together that their net worth is much higher than US economy. So it's very different. It has nothing to do with US economy. The only other side that I like to educate my clients and you is, unfortunately, our media culture is a fear-based culture, right? If you listen to the news, open any of the channels, MSNBC, the finance, they keep you in that we're at the verge of economic downturn, market is down. They're constantly keeping people in that fear, which I completely disagree, right? And then of course we will never invest if we fear the stock market. So understanding how it works, it's going to be important. Kristen, I think you mentioned you have Acorn. That's fantastic. Love Acorn. Ameritrade is great. Economics podcasts are wonderful. If you guys want any podcasts, I'm happy to send those over to you. Jacqueline has a good question. 1 and 1.5 average for a financial planner to charge. That's pretty accurate, Jacqueline. So yes, thanks, Susan. I'll send you some podcasts, definitely. I hope you don't mind. It's not true that we can multitask, so I can't type in right now, but I'll create a whole separate email with some resource pages and send it over to Ivy for all of you. Talking about financial planners charging, you know, yes, they do charge, but that 1 and 1.5% goes to very, very complex things. Like those are the geeky things that we do. Building portfolio allocations, how your money is invested, doing tax loss harvesting, giving you advice outside of what's outside, not just your investments, but giving you comprehensive advice. I'm happy to dive into a little bit further, Jacqueline, if you have other questions. Yeah, NPR podcasts are awesome. If you guys don't listen to Marketplace, Marketplace is great with Kai Ryssdal. It's phenomenal. So I'm just, yeah, Planet Money. Yes, we can geek out on podcasts. And then one last one that comes to mind right now, I'll let you know, is Invest Like the Best. It can get a little technical if you're not in the world of finance. Maybe it can get a little boring if you don't understand, but it's a phenomenal podcast. They get some really good guests and talk about economics. They talk about stock market and inflation rates. And it's really, so Invest Like the Best. And Good. So, why do we have to invest? It's because the wealth in the United States is built in the stock market. Because I'll tell you why. Before the pandemic, one Amazon stock was worth $2,300. That was around January. Today, it's worth over $3,000. One Amazon stock, because even though we are going through hardship economically, there is an actual health crisis. I want to pause and let each of you know that unlike what you hear maybe on TV, we are not going through a financial crisis. What we're going through is economic crisis and a health crisis. And unfortunately, the current environment or current White House is not handling the economic crisis, actually both very well. I'll stop at this point. I don't want to dive into it too much, but why do we have to invest as soon as possible? Because when we invest, 50% of your wealth in the future will come from that very first 10 years of you investing. It's really rare in the stock market and companies that are publicly traded that we can actually go invest in. It's really rare that they actually go down, they completely go bankrupt. Generally, they're absorbed by other large corporations, and the stock market has grown. It's one of those things that we can never know what's going to happen. If you talk to an advisor who can tells you I can guarantee certain rate of return, please run away. There's no guarantees in the future, absolutely not, when it comes to the market. But we know that market constantly goes up and down, but in a 10-year period, twice market is down and 8 years out of 10 market is up. So this basically just shows that basically, I guess the best way I can describe it, let's use the Roth. I don't know, are there any 20-year-olds in this group? I don't know if there are, but let's say someone is 25 years old. I'll give you exact numbers. I love Susan is laughing. I'm not in my 20s either. So let's start. If let's say you're 25 years old, you have a little bit of extra cash. All 25-year-old has to do is invest $380 every single month in a market and not touch those dollars for 40 years, and they'll have $1 million. I'm 42, I'll say it. For me as a 42-year-old, if I want to have $1 million in the future, I have to invest around $1,500 every single month without missing a month in order for the money to compound and grow into the future. So Mikhail has a really good question. If we invest on something, how do we get the physical money back later on? So here's what I tell my clients as a planner. If you think you're going to need your dollars within the next 2 to 3 years, investing in the stock market is incredibly risky because we just don't know. We live in right now we're going through crisis. Election years tend to be volatile years. We have to be in a market at least 10 years. That's it. So that's why 401ks, Roth IRAs, or traditional IRAs, other retirement accounts are so successful because we don't touch them. And when we arrive at 60, 59 and a half, when you can't touch them, all your money is there, plus it has doubled or tripled, quadrupled your dollars. And even though it will still fluctuate, those dollars, your principal that you've put in it will never be lost. So with my clients, we take a very strategic approach. If you need your dollars in 10 years, it's a very, very different approach in how risky your portfolio is versus someone who, let's say, Whitney said she's 34, she feels behind. You know, you're fine, Whitney. I know that you feel behind, and the truth is, let me actually pedal back. Let me just kind of finish my last thought first, and then I'll come back to you, Whitney. So if we have the 20-year timeline and we know we will not touch those dollars for 20 years, likelihood of you losing your money is zero. The only time we lose money in a stock market is we didn't plan correctly, we didn't have an emergency fund, we had an aggressive portfolio, something unexpected happened that we needed funds, and we were forced to sell those funds during the time like the ones we live in today, right? Volatility, constantly one day market is up, one is down. We're expecting another downturn in the next few months. So that's why when we're planning, it's not, by no means, I don't want you to take this as an invitation to take all your dollars and invest in the stock market. Please don't do that. Having a protection is most important. Have an emergency fund, have all the insurances in place, and then think about what are your goals, right? And then we set aside a small amount that you're just not gonna touch for years. Whitney, coming back to you, if you don't mind, you said you feel behind. The truth is, we all feel behind. I'm sure you guys know who Warren Buffett is, right? There was an interview with him. They asked him, when was his first investment? And he said, I was 7 years old. And then he said, and I feel I was 7 years behind. What does that mean? It means he lost 7 years of compound interest. So the good news is you're still in your 30s, you have at least 30 plus years of investing. Generally in a stock market, if you're investing consistently every single month, your wealth doubles itself every 10 years. So you still have time. But with that said, we do follow the philosophy of the wise man of Warren Buffett is, when do you invest? We say before the sundown, right? It doesn't matter about the dollar size. I'd rather my clients invest $100 today than wait, in the future and invest $1,000 in the future. You will miss out on the growth opportunity. I know I hope I'm not digressing. I want to see if you guys have, is this helpful? Yes or no, maybe thumbs up if you have additional questions. And then we'll talk more about other fun stuff. Okay, and then Mikhail, I don't know if I answered, or Mikhail, I don't know if I answered your question about when you get your physical money back on. It's that, 20 years. If you cannot touch for 20 years, you're good. Basically, your risk goes down to zero, but in the first year when you're investing, your risk is about 48%. So that's why we always recommend, please do not touch those dollars for at least 5 years, please. Okay, great. Thank you for your feedback. And let's see, protection piece. I kind of dove in and out of the protection piece. Generally protection piece has about 3 layers. We talked a lot about, emergency funds, but also protection piece, at least in this country, is having insurances, because you only have a financial plan when you're healthy, meaning you're able to go to work and earn income. So understanding your health insurance and your health insurance coverage is incredibly important. So if, for example, when we discover that a client's health insurance has a high deductible, we might actually change the amount of emergency fund they need to keep just in case, right? The second level of protection is, then I'm not sure if the union does it or not, but California state mandates that we have short-term disability, that if you're hurt, injured, can go to work, you have coverage for 3 months. Long-term disability is if your injury takes longer than 3 months to recover. Then at that point, the state benefit is done, then who's gonna pay your bills, right? When we're young, we're in the process of building wealth, we don't have enough wealth yet to take care of us for years. all our clients, we do analysis of their work benefits, make sure they have the long and short-term disability insurance. And I think what Jacqueline was asking me about, if this is all about life insurance. It's not. Life insurance is if I discover that, let's say you guys have a large mortgage, you have young children, you have a lot of debt and family to take care of, then if that's the case, there's a basically huge need for it. It's not a good need for everyone, especially when you're young, no kids, you probably don't have any needs for it, unless you have a lot of debt. Because unfortunately with debt, if any of you here have private student loans, those loans never go away. Even if you pass away, your loved ones inherit that debt. So those is, again, this is the type of geeky stuff that we do as planners, making sure that our clients are protected, but health insurance is number one. And so protection is really, really important. You know, it's basically the same thing I talked about is, you know, pregnancy, heart issues, cancers, back problems are the only things that stops us from going back to work. And we want to make sure that we have our income protected. Okay, so any questions so far? I want to have a pause for a moment and see if you guys have any questions. Okay, I'm gonna skip this and give me 1 second. There's a few chats. And I just came back to this cycle again, and you know, I didn't want to dwell too much into the insurance planning because that's a very unique event for each individual. But again, I'm coming back to here. How is financial security built? Is you know, it's you gotta pay yourself first. There's no way around it. Is save, save, then spend. I guess what I'm trying to say is like most people, especially young ones that I talk to, and I'm gonna pick on you, Whitney, because you're 34 and that's young. You know, most of them I talk to, they spend on the lifestyles that they'd like to do and they hope something is left in the end of the month. We just flip that around in a planning environment and say, no, please save first and then spend the remaining, right? And then, of course, growing your wealth is really important. Protecting your wealth is really important, and giving back. For us, is giving back is generally in what we find is in the later years. I have a few clients in their 60s and 70s. They're all taken care of. They're going to have great retirement. They have legacy planning for their children. They still have extra. So what we do is we encourage them to think about what they're passionate about so we can give. Until then, the giving part can be in form of volunteering. That's what I'm doing right now, right? It could be in terms of just helping someone, and you know, it's however you want to do it. But generally, having all those aspects of your financial life taken care of is what's gonna let you arrive at, let's say, 65. I'm assuming that's, let's say, 65, and we're in a position where we're not relying on Social Security only. You know, how many of you guys know someone who has a really good life just living off Social Security? Right? It's just not possible. And I'm gonna stop sharing for a moment. I want to see if we have any questions. I would love to. Let's see. I think I stopped sharing. I hope I did. Let's see. Any questions so far? Okay, so if you guys are up for it, oh, good. Sissy, would you either unmute yourself or you can type the question? I would love to hear your question about debt.
Hi, I did type the question, but I'll just go ahead and say
Oh, I'm so sorry. I think I couldn't. Yeah. Mm-hmm.
But yeah, my main thing is, so I'm 33 now, and
Mm-hmm.
one of my main things is that I will really want to tackle my debt. I have a lot of debt stemming from student loans.
Mm-hmm.
And how do I go about doing that?
Yeah, that sounds great. So quick question, Sissy, do you know what kind of student loans do you have right now?
I have a private student loan,
Mm-hmm.
and I have federal student loans.
Great, great. So The very first step, Cece, I would say become friends with your debt. I know it's painful, but I would find out exactly the interest rate. You might know it, but most people I talk to, they really have no understanding. What is the minimum required payments? So from the hierarchy of debt, Cece, private student loans are considered the worst type because they're not forgiven, right? They're not even forgiving right now during the pandemic.
Right.
Right, you have to pay the private ones, while if you have a federal loan, because of the CARES Act, it's been put on pause until end of September and no interest is being charged. So I would say just create a little spreadsheet. If you need my help, let me know. What we do, we create a spreadsheet and we tackle the private loan first. What does that mean? That means the federal loan gets the absolute minimum requirement payment. The good news is you don't have to pay it right now. Within a week, the new stimulus package will come, so we'll know more in terms of what other benefits are going to be moving forward. But right now, I would say, utilize the fact that we're all home. You're not going anywhere, we can't travel, and try to put as much as you possibly can within your budget towards the private loan. With that said, Cece, if you don't have your emergency fund, don't put all your money towards the loan and not have an emergency fund. So can I give you a hypothetical scenario, if that's okay?
Yes, please.
Let's say you did a budget and we discovered that you have extra $500 per month left after your expenses and even have fun money. What I would do, I would split that $500. The $250 will go to your emergency fund if you don't have it. The other $250 will go as an additional payment towards your private loan. So the private loans are the ones we want to get rid of as quickly as possible because they tend to be higher interest rate and are never forgiven.
Okay.
Yeah.
Thank you so much.
Yeah. And so the reason I'm insisting on that, it's because if, again, an unexpected event happens, for us, unexpected event is, my father-in-law got diagnosed with a cancer. We're flying to Colorado. That's an unexpected event that will happen next week. So what happens is that I don't have to worry about anything because I just tap into the emergency fund. I don't ever want you to be in a position to go into more debt because we were putting all the money towards paying down debt, if that makes sense. Yes, am I making sense?
You're making perfect sense. Thank you.
Awesome, awesome. No, thank you. And I'm so sorry if I missed your question. I see it now. Whitney, you talked about being behind. For you, I would say, basically, I'm going to invite you after our conversation today. Please do the budget and come up with a number that you can part with every single month without missing those dollars. It could be 100, could be 200, and please invest it. And if you need help with picking a mutual fund or understanding how it works, that's really what my job is, right? Let's see, Susan asked if it's possible to transfer a private student loan to a credit card with 0%. I actually have seen a client do that, but they worked with student loan kind of forgiveness, not forgiveness plan. Republic Bank right now, Susan, First Republic Bank. They are an absolute leader in taking care of student loans and doing transfers or refinancing. They are number one in the financial industry. I'll make a point of sending, you can, actually, it's been done before. Sometimes they ask for collateral. So it all comes down to your own unique situation. How much is it? Your credit score and quite a few things. I hope this was helpful, Susan. Yeah, congrats to you, Whitney, about paying down all the debt. Yeah, I mean, I will tell you, you probably heard the numbers. There's over $1 trillion of student loan debt that exists in the United States. And that's number one reason why people are not investing and saving right now. And Barbara, you are correct. Actually, all debt builds credit, all of them. It doesn't matter if it's student loan, private loans will build the credit a little bit more. And of course, the credit bureaus are constantly monitoring your payment schedule. If you're missed 1 month, sometimes it depends on the company. Sometimes they will actually report you right away if you even miss 1 month. But yes, it is, you know, sometimes having debt actually helps us build credit. So we arrive, let's say, in our 30s or 40s with a really good credit, and we're able to buy a car at the lower interest rate, buy a house, or qualify for a larger amount of mortgage. Yes, Wendy, you have a great question. Is there a formula that can inform us how much we need to take retirement? The formula, yes, there's a formula, and I hate that I don't have an exact number, but it ultimately comes down to an individual's lifestyle. You know, I have clients who say, I want to have a lifestyle of $10,000 per month at retirement. And you know, and then what we do is we take what they have done. We have to also take into consideration the income of inflation and taxation. Um, um, so let me just pedal back, Wendy, because the formula is quite complex, right? What we do is we say, okay, if you want to have 10K of income, what year do you want to retire? If you retire at 65, an average American woman lives till 92. An average American male lives till 90. And actually 1 in 10 women right now, their statistics are that will reach 100. And 1 in 4 will reach 95. So my job is to calculate 30 years of income for you after taxes and then after inflation. And so generally speaking, we know that if you're starting sooner, you've got to save 30% of your income to have a financially secure future. But to answer your question, it's a very individual approach. I have to understand you as a person and what kind of lifestyle you envision. I have a client, she's wonderful, she's in San Francisco, but her vision of retirement was a small cabin in Lake Michigan, and that's exactly what she's doing. She loves it. She needs only about $2,500 to $3,000 a month to enjoy life, and she's set. But if someone says, no, I want to travel Europe, go to work, I want a luxurious lifestyle, that's a whole different planning. Again, I know it's not as straightforward, but the formula is saving 30%, but unfortunately saving is not enough because every year, you know, let's say we always say, oh, if I have $1 million, I'll be okay. But $1 million 30 years from now is not really worth $1 million that it is today because of inflation. Plus, unfortunately, we're all headed to a higher tax environment. So the impact of taxation and inflation and the health event are those 3 reasons why people's wealth erodes and disappears in this country. So those are the main 3 risks that we have to cover. So good question, Wendy. Consulting a retirement professional, yes, I encourage that absolutely, especially when you get in your 40s, 50s especially. A majority of my clients are in their 50s. And that's exactly what we're doing. It depends on who you talk to. And by the way, I'm answering the question, Wendy's question about how much the cost is. It's going to be based on who you talk to, Wendy. Personally, my team and I, we don't charge a fee because we want to build a long-lasting relationship with our clients. We will only charge a fee if a client comes to us and says, not interested in working with you, we just want to see an actual financial plan. It's about a 60-page document, basically that analysis you're talking about. But we don't charge a fee if a client wants to work with us and if they want us to help them invest, plan for taxes, and all of that stuff. General cost, and those are general, it could be anywhere from $3,500 to $5,000 depending on complexity if you only want a fee basis. But we don't charge a fee for that because my philosophy is like, why charge you $3,500 when we can actually invest at $3,500 for you? And that's where we come in. So I don't know if this is helpful. Wendy, just let me know. You can unmute yourself if you would like. Yeah. Yeah, you know, with Ivy's permission, I can type this for you guys right now. I am also old school. What does that mean? I'm in my 40s, don't do the texting and the TikTok so much. I do answer my phone calls. So if you guys want to talk to me, the only downside of talking about finances, I can share general concepts, but I will be honest, is when it comes to financial planning, it's, to me, it's a two sides, right? It's that philosophy, your dreams, your. So any other questions? I'll just pause for a moment. Oh, what I was gonna say, I got interrupted, and then I'll let you guys go because I know you're working. To me, financial planning has it's 90% philosophy and who you are as a person, your risk tolerance, your dreams, your goals, your relationship with money. Our background is really important. You know, and then it's 10% the math, because if you do it, the math is easy. Each of you can go online right now, type in the Google, let's say financial calculator, rate of return, how much money you can invest. It will show you what's going to look like in the future. But what we deal with, I would say, is a human behavior, who you are. So when I talk to my clients, I know who they are and how they feel about market volatility, you know, how they feel about the future. Some are comfortable, some aren't. How, you know, some clients are nervous, so we keep more cash in their account. So it's, when it comes to truly planning, it's a very unique event. And then CC, actually, Ivy, is that okay if we're going over 1 o'clock? Just a quick, if you guys are okay, I'm okay.
Yeah, it's not a problem to go over if people have questions and stuff. It's
okay.
No problem.
Okay. So I have about 15 more minutes, and then we can always take it offline if you guys want. How to manage your Roth IRA? Good question, CC. I'm a huge fan of Vanguard, Fidelity, there's Betterment, there's Wealthfront. Those are robo-advising kind of, basically the reason I like them, let's pick Fidelity or Vanguard. Why I like them is because their fees are incredibly low. They use a robo-advising model. What does that mean? It's a purely data-driven model. What the robo-advising does, they just take the data in the past and then create an algorithm that says, okay, if you want to grow your money here, here's your portfolio. And also, CC, I don't know how old you are, but if you can not touch those dollars in your Roth, oh, you're super young, awesome. So for you, I'm going to recommend use an aggressive portfolio. Aggressive meaning predominantly stocks. And I'm happy to send me a quick email. I'll send you some funds that I'm really fond of, or even the same fund that I invest my Roth IRA. But just be aggressive, just stocks, almost no bonds, because if you guys don't know about IRAs, is you can't touch the money until 59 and a half. If you do, there's a penalty. There's a few scenarios that you can take the money out, like buying a home, education planning, but I generally say develop the mentality of not touching those dollars until later in life. And if you continue doing that, CC, I'm gonna geek out for just a second. Allow me, I'm doing this so I can inspire you guys. So let's say, CC, you work until 65, and you max out your Roth IRA, which is $6,000 every single year maximum, right? So what's good about it, you will put away $6,000 every year for 32 years. That's $192,000. An average portfolio will give you about 8% rate of return. You will arrive at 65 with $805,000. And of course, the difference is not taxable. So I'll highly encourage that, be as aggressive as possible. You have a lot of time. Great. So Zelda has a good question. The good news about Social Security pension is we view Social Security and pension as stable sources of income, right? Why? Because government guarantees, right? They're going to give you those dollars every single month. And then I do have some good news. I don't know how many of you have had conversations about Social Security is going away. It's actually not true. The basic benefit of Social Security, which government will send you money every single month, it's that portion of Social Security is funded all the way till year 2100. So the portion that you get heard about a lot that says, oh, it's going away, it's that portion of will we have free Medicare, that's Medicaid, Medicare portion, or disability insurance portion. That's the one that gets tossed back and forth depending who is in a White House. So good news is you guys will have Social Security, and I will encourage you, and every year that you wait and not apply for Social Security benefit, your benefit actually will increase by 8%. What does that mean? We are qualified to apply for Social Security, I think like 62.5, but if you wait, let's say until 65, your benefit will be higher because every year you wait, it's growing by 8%. It's good. So yeah, it's good news. Pension is great. If you guys have pension, then congrats, you're a unicorn, a rare sight because most people don't have pensions anymore. And investments, but we simply know that even with pension and Social Security, it's just not enough, unfortunately, because both pension and Social Security are going to be taxed. So having a Roth IRA, that money grows tax-free, is an absolute must in my books. Investments, absolute must in my books if you want to have a comfortable life. It's just simply not enough, unless you got to move from California and go somewhere. So yeah, let's see if any other, yeah, so there's Zelda saying good news. So really what I'm going to encourage you guys is, I made an error here. My phone number is the 415 number. Here's my email. Send me an email, please. I'm an absolute geek when it comes to numbers. I love talking about this. And if nothing else, I'm happy to talk to you. You'll walk away more educated than you were before. And that's basically where I'll just conclude by saying, you know, financial security is really a feeling. It's not about the dollars, zeros in your bank account. It's a feeling knowing that you're okay and your family's okay and you're gonna be comfortable. The reason I say this, I used to work for one of the billionaires in Silicon Valley. Unfortunately, can't say who it is because everyone knows him. But you know, when I left, their net worth was 35 billion, and his wife was constantly terrified that people are going to steal their wealth. So even though they had 9 zeros in their bank account, psychologically she was afraid. So my job is to make sure that we arrive at 65 psychologically feeling secure. Like, yeah, I'm good. So that's just a little bit of kind of a philosophy of mine, but I think that's it. So my promise to you guys all, it's such a pleasure. I wish we could be together in person. But my promise to you is I have to run into a few meetings today, but by the end of today, I'll email Ivy some podcasts, budgeting information, just maybe a little piece about investments basics and then I'll ask her to share it all with you. And feel free to email me anytime. I think that's it, Ivy.
Amazing. Thank you so much. I'm so glad that people are excited about getting in touch with you, and hopefully we'll have some more classes coming up about different topics.
Absolutely.
As soon as you send those documents to me, and no rush, we understand that you're working professional, that I'll send those over to the people that participated in this class today. But thank you guys for everybody for coming and being a part and taking the time to teach us some really cool basic stuff. So I really appreciate it.
Yeah, and then come up with some topics, send it to Ivy, because financial planning is a massive undertaking.
Yes.
In so many areas of our financial lives, and that's really how we work with our clients. We break it down into, okay, today we're going to talk about this. So I'm happy to do that as well.